trade deadline has passed without a deal, and Washington has hiked its tariff rate on some Canadian exports to 35%. Will that pose a serious headwind to our economy? Joining us now to discuss, Mark Orcoleo, economist with TD. Great to have you on the program.
Thanks for having me.
So here we are, it's August 1st. We didn't get the deal. We didn't get the tariff hike. What does this actually mean for the Canadian economy?
Sure. I mean, it's disappointing that Ottawa and Washington weren't able to negotiate a trade deal by today's deadline. That being said, we don't think that this 35% tariff on some Canadian exports will be as impactful as some people might think. And that's for a few reasons. One, that 35% doesn't stack on top of sectors that are currently facing the Section 232 tariff. So your steel and aluminum, your autos, your energy exports. These are still facing tariffs, but they're not exposed to that 35%. The secondary factor here is that it only applies to Canadian goods exports that are not compliant with the USMCA agreement. And the data tells us now that 60% of the goods we ship are actually USMCA compliant, and we expect that share to continue to tick higher. So this 35% is affecting a smaller subset of Canadian exports. So it's not trivial, but it's definitely not going to, we don't think, move the needle that much.
So it's not a huge development on that front, and perhaps the talks will still continue. We do know that we have had certain parts of the economy hit by the tariffs that are in place. What parts of the economy are feeling it the most?
Sure. So first, I would say when we're looking at exports to the U.S., we have to smooth out the noise we've seen over the past several months. Over the last 2 months, we've seen exports crater. The months prior to that, we saw a huge build, at least on the U.S. side, of front-running some of these tariffs, importing a lot of Canadian goods at a rapid pace. And when we smooth that out, and maybe to nobody's surprise, we do see that the sectors that have been directly targeted by tariffs are underperforming in terms of exports. And I have a chart on this. We could see steel is probably the biggest one, down almost 10% relative to 6 months ago. But other sectors like autos, energy, and aluminum, there's still some growth in exports on a six-month basis, but it's still sub 4% versus other parts of the economy that are still seeing decent export activity to the U.S.
There's been a lot of talk in this country and going back many years and through different governments about the need to diversify our export partners. We heavily rely on North-South. Are we seeing any offset? Have we managed to find East-West partners?
So we're seeing some offset, not enough to offset the drop in exports that we have seen to the U.S. And just for some context, historically speaking, we've sent around 75% of our exports to the U.S. And depending on the economic cycle, that's been anywhere between 70 and 80%. But for the second time on record, we've seen exports to the U.S. fall under 70%, meaning non-U.S. exports are receiving over 30% of our goods shipped. Now, a big part of that is a rotation of gold exports to the U.S. to the U.K. And so that's a narrowly based factor. But even if you strip that out, we are seeing an increased share of our exports go to partners like the EU, Japan, Singapore, Indonesia, to a lesser extent China. But there is some evidence to suggest that Canadian goods are being shipped elsewhere.
Right, so from your first chart, we saw the impact we've obviously seen from the steel and aluminum tariffs in a certain part of the economy. The uncertainty overall about the path that we're on, is this starting to hit the broader economy at all? If you think about business spending plans or even the labor market?
Yeah, so we are seeing that. And the way we would look at it is if you can bucket Canada's economy into two areas, one of highly exposed U.S. trade sectors and ones that are more insulated. And by that, we just mean the number of jobs that are directly tied to exports to the U.S. And in that category, you'd have things like manufacturing, you'd have our energy sector, agriculture, transportation, and warehousing. And altogether, this counts for about a third of the economy. Now, if we take a look at the chart here, we could see that real GDP in these high export-reliant sectors has basically just been flatlining and being kind of pulled up by the low export-reliant sectors. Now, overall growth has slowed in general across the Canadian economy, but more so in those higher export-reliant sectors. And that trend is mirrored in the labor markets as well, where any job growth we have seen since Trump's taken office has been in those low export exposed sectors versus that flatlining that we're seeing in the high export exposed sectors.
You got one more chart for us. Let's throw it up on the screen and tell the audience what they are looking at.
Well,
that was it. Okay, I lost count myself there. Right?
Yeah.
So there's a lot going on here. Obviously, there's a lot of uncertainty. We just heard from the Bank of Canada this week.
Yep.
They're dealing with that uncertainty. Now that we're at this point, what does it mean for the Bank of Canada? What does it mean for interest rates?
Well, just this week, the Bank of Canada decided to hold the policy rate at 2.75%, and that's right in the middle of their neutral rate range. In other words, they think at this stage, they're okay with where the economy is in terms of the interest rate that's now being applied. That said, they're balancing and continue to balance two factors. One is the potential for further downside risk to Canadian economic growth, and the other is the further upside pressure that we might see on inflation. On growth, they've acknowledged that there's some form of economic resilience taking place in the Canadian economy despite the slowdown. And on the inflation side, while headline inflation seems to be under control, it's that core inflation measure, that underlying inflation pressure that's still a bit sticky and a bit elevated. Now, they haven't closed the door to further interest rate cuts. They've acknowledged that, should conditions, find themselves, in a situation where we see more economic growth deterioration or we see inflation start to come down, that they are open to more interest rate cutting. And we'd be sort of in that house as well. We don't think that the Bank of Canada is done cutting interest rates, but should they cut further, it will be later this year.
If someone sees the headline today, where we started, the headline today, Canada does not get trade deal by August 1st, tariffs going higher, what's the main takeaway they should have from all this?
That's a good question. I mean, we've been operating under a tariff world now for several months, and it's not ideal, but businesses and consumers are beginning to adapt to it. There's going to be lingering uncertainty now for the next several months, if not years, and it's just about how within Canada how we react to that and how we deal with it. And so far, I think we're doing a decent job. And our policymakers are always in contact with the U.S. in terms of trying to strike new trade deals or trying to get the most favorable outcomes, and not just for Canada, but for everybody involved. So the worst case scenario is not manifesting, and we should be a little bit optimistic about that.